The big brokerage firms are fighting for your investment accounts, and this is not good. Our investment advisory firm, over the years, has never been a favorite of the big brokerage firms because we generally do 3, maybe 4 trades on average per year. We just don't generate a lot of money for the big Wall Street firms. But the big brokerage firms are now acting like the casinos in Las Vegas and are doing everything they can to get you on their platform. They will give you all kinds of tools and seminars so you'll take higher risk and do more trading. In the meantime, and this bugs me, they're downplaying the risk of trading. They say, oh, yeah, this is great, and they're pushing it because why? The more activity you do, the more they make.
Yeah, and I mean, you can also see like the casinos in Las Vegas, there are now stories of them giving away free rooms for the big players, so to speak, the big traders, I'll call them, and they are giving you free software and free education on how to trade. Robinhood, who I'm going to say is the biggest abuser of this, obviously the riskiest custodian
They are almost
of
like
them.
a casino.
Yeah, I mean, it's nuts. I mean, they had invited 1,000 people to Las Vegas, where the casinos are held, and took them go-kart racing and then provided classes with their new trade platform. I mean, Schwab and Fidelity are doing similar types of events to get you to use more of their services. I'm not going to say I haven't read anything that Schwab and Fidelity have done go-kart racing, but I know Schwab has they bought the Thinkorswim platform. I mean, they're definitely not encouraging trading.
And that's just the game now for the big firms. And the thing is, once they get you in the door, they can show you how to use margin debt, which, by the way, had another new record in September of $1.13 trillion, along with option trading and other exciting ways that make you think you can make a lot of money by doing what they tell you to. These guys know what they're talking about. People think. Doesn't that sound like the casinos in Las Vegas that try to get you to hit the gambling tables? That's what they're doing. They're creating this casino thing in Wall Street. I'm not in favor of it.
I don't know. We were talking, every time I go to Vegas, I win.
I thought, well, you told me you lose all the time.
I do. I mean, I generally cap it at about $100, just and I don't go very often. So, but every time I go and I lose $100, I'm like, I knew this was going to happen. Why did I do it? But as we always say, that's why the casinos in Las Vegas is so nice there.
Yeah.
And I think the same thing with the brokerage firms. I mean, even Robinhood, they're making a good amount of money. How are they affording, to take people go-kart racing, to take 1,000 people there? Well, they're clearly making profits. So, And again, I don't want to demonize profits. That's not something that I have an issue with. The issue really more becomes maybe that false sense of security in trading that they are teaching to people.
And they're doing it like the casinos to get more revenue based off of you. And this is why the little guy many times in investing doesn't do well, because they get all excited about the hype. And the way we talk about investing sometimes can be boring. We'll buy something, hold it for 3 to 5 years. Like, what? That's kind of boring. I'd rather have something I can buy, sell. Oh, that's so exciting. But we generate profits, revenue, increase in investments by doing investing properly. But the Wall Street has said doesn't make any money off us. Our clients do.
Yeah, and I mean the thing that you look at here as well is these brokerage firms and kind of encouraging people to trade. I mean, whatever they're doing, it seems to be working, and I'm all for more people investing in the retail investing crowd. I don't have an issue with that concept. The issue that I have problems with is how they invest and the risk that they're taking without realizing that. And what I mean by saying it seems to be working is the percentage of investors who now have self-directed accounts is 33%, which is a big increase from 24% just 5 years ago. And the issue that I have here again is this is kind of what happened in the tech boom.
Yeah.
Retail investing got very big, and then what happened after the bust? Shrunk.
Oh, yeah.
Are we going to see that again? Is it going to get very big, and then you kind of encourage all of this crazy behavior? Because these custodians, these brokerage firms, I guess I'll say instead of custodians, is they're not really teaching people how to invest, but rather more how to gamble and make that quick buck and do the 0-day option trading and the margin debt, which makes them money, but many times maybe not the investor money.
Well, Chase, going back 100 years, it's still the same thing with Wall Street. Wall Street will make some big profits, and the small investors, well, they'll lose most, if not all, their nest egg because of the excitement of what Wall Street did. And the fat cats on Wall Street, they will walk away with their pockets lined with a lot of money. And then all these programs they did and talked about, yeah, the little guy's going to lose their nest egg. I hate to say it.
I remember this is years ago. I mean, this is nothing new, but I remember we had a client come in and it was this trading software that, when the green button flashed, you bought. And when it was red, you sold. If it was that easy, everybody would be not just millionaires, everybody would be billionaires, because then you could leverage up, you could take on margin, and you'd always win. That's not how it works. And I'd love to sit here and tell you that you could make 20% a year. If that was the case, everybody would be extremely wealthy, and that's not how it pans out. That's why when you look at just owning businesses, and we tell people, if we could do 8 to 10%, we're thrilled with that. People look at us and say, you're crazy. I could do way more. Long term, that's how you lose. And you might win for a few years, but like when I started in my blackjack days, I won like the first 6 months. I'm like,
that's right. You make a lot of money playing blackjack.
I was in college. I made thousands of dollars. And I'm like, this is great. Today, I'm down probably $1,000 on my gambling career. Just because you win for a period of time, it might be 6 months, it might be 3 years, it might be 5 years. You don't want that short-term winning. You need to win over 20, 30, 40 years.
Lifetime.
And this trading is not how you're going to get there. It's by buying good businesses at good prices.
Yeah, and that's what people don't realize. It's not 3 to 5 years is not a long time. You are investing for your lifetime, which is hopefully 50, 60 years that you live to be in your 80s, 90s. And if you think you did well for 3 to 5 years, yeah, congratulations. But as Chase just said, he did great with blackjack for a while, made thousands of dollars. All of a sudden, it doesn't work any longer. What does work is investing in companies at good prices and let that company pay you dividends and so forth. That's how Warren Buffett became the most famous investor in the world.